So if I've got it, let's just say I've used it for an ordinary investment, then obviously the ordinary investment is going to have a taxable event, but I'm going to be able to deduct part of that interest part of that return by the interest I've paid. So as an example,
Gotcha.
let's say I'm earning 12%, but I'm paying 5 for the use of money. So now I'm only going to pay tax on 7 instead of 12. But the
Okay.
beauty of life insurance is even when you have a loan, your policy still compounds and grows in and of itself. So I may be paying 5% interest, getting a deduction, but then my policy is still growing internally at 5.5 or whatever that number is. And so I still get my 12%, but instead of paying taxes on 12, I'm only paying taxes on 7. So it's a much more efficient way to fund your investments.
Welcome to CRE PN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dan Thompson. Dan is a seasoned financial advisor and investor. And in just a minute, we're going to speak with Dan Thompson about tax-advantaged investing. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Dan Thompson. Welcome to CRE PN Radio.
Well, thank you. Good to be with you today.
Well, I'm looking forward to our conversation. But before we get started, if you could share with the listeners a little bit about your background.
Yeah, I started in 1986 as a traditional stockbroker, and that kind of transitioned into kind of a financial planner, if you will. And I did that for quite a while until after the dot-com boom and bust of the 90s. I realized I had to find a better way, so I kind of went on a hunt for a couple years, just looking for the best, most practical and predictable ways to build wealth and cash flow and tax advantages, and it's kind of evolved with what we do today.
Got it. So you mentioned kind of a hunt. What is it that you found that what were you looking for and what did you find?
Well, I was looking for safety first, and then again predictability, but also a way to get into some decent returns. What I found originally was this thing called infinite banking or bank on yourself. But I found pretty quickly after kind of employing some of those strategies that really wasn't the way to build the wealth. It was a great way to store your capital, but to turn around and then use that capital to buy cars or an RV or go on a vacation just was not going to build your wealth. So we started strategies that you could take the policy, use it as collateral, and then fund other investments. So early on, I actually started a home building company using my policy as the funding mechanism, and we ended up doing, gosh, I think last year we sold about $50 million worth of homes from that. And then so really the whole plan is we just help clients build up these policies because it's a tax-free environment, it's a safe environment. guaranteed environment for the most part. And then we can use those policies to kind of double dip, have the same dollar working 2, 3, 4 times for us, and get into other investments. We love real estate, of course. And as an example, last year, last year, I guess technically, just about 8 months ago, I bought a student housing complex at Texas A&M using my policy. What we found is when we run the calculations is that every investment gets better if you've used your policy as the funding mechanism. So that's kind of how it's evolved over the last 20, 25 years.
So take me through that as far as the vehicle, and I do like the fact that you're suggesting not to go out and buy the luxury lifestyle items and fund it, through your life insurance policy there. But so you, if I understand right, I mean, I'm assuming you're using whole life. Is that the vehicle?
That's the primary vehicle. We do blend every once in a while, depending on the age of the client and so forth. We might blend an IUL, which is an indexed universal life with it. But yeah, the whole life has kind of been the flagship stable asset to use.
And is that any kind of a special whole life policy, or is that just any carrier whole life policy gives you this uh, option to use the proceeds?
No, so I mean, any carrier will let you do some policy loans, but we found after just some really in-depth studies that there's only a few carriers that really have performed well. So it has to be a well-designed policy. It needs to be designed for cash value rather than death benefit. It needs to be with a company that's got a great track record of keeping up with their dividends. And obviously, we want to make sure that we have access to as much capital as quick as we possibly can. So when it comes down to it, we've found probably about 3 or 4 companies that work well with this strategy.
So you sell or buy, somebody buys a policy, and for example's sake, can you provide some sort of like a numbers to kind of illustrate what the options, or what the, I guess, what the premium invested versus the amount you can um, borrow to invest?
Yeah, so one of the companies that we work with has a really unique program, mostly for business owners. Now, it does take a pretty good chunk of premium to get it going, usually around 150, 160,000 in premium. And then you can get as much as 90% of that, just within a week or two, just as things clear and that cash value has been credited, you can have access to it fairly quickly and a really good chunk of it. For the most part, though, you're looking at about 70% the first year, 80 to 85% the second year. By the third year, though, every premium you've put in is pretty much accessible to you immediately. So we typically will get going much sooner than 3 years with different investment and alternative ways to use that capital. But that's kind of a good rule of thumb.
So you buy the policy, you fund it. Can you do a single pay, or do you have to spread out the premium over?
So that's what really makes us unique. We have a strategy where we like to do at least two premium payments. So we'll call it a two pay, if you will. And then we can show you how to leverage going forward so that you can kind of use the same dollars to pay future premiums. And that makes us about as unique as it gets out there, because I think you'll find with just about anybody else who is in this space, premiums are typically 7 to 10 years at a minimum, but we can kind of force feed these policies, get premium in for a couple years, and then just with our very unique strategy, and I don't want to go in too much detail because it probably be
Sure.
a little bit hard to follow on this podcast, but we build these designs and show you just exactly how to make that work so that you can leverage your policy going forward after that second premium.
Got it. So just conceptually though, so you buy the policy, there's cash uh, value in the policy. You can then get a loan against that, correct?
Yes. Yeah,
Okay.
two ways to do that. You can borrow directly from the carrier, the insurance company themselves, or what we have found over the last, 20 plus years is that outside banks actually can give us even better interest rates for that borrowing. Now, this last year's been interesting as interest rates have risen so quickly and banks have gotten tighter. So we've gone back to the carrier loans for the most part currently, but within, whenever interest rates kind of balance out and figure out where they're going to land, we'll most likely use outside banks for the line of credit against the policy.
Got it. So I buy a policy, I borrow the capital from that policy, or a large percentage of that. What's the typical payback interest rate of the of the money that I've borrowed from the insurance company or the bank?
Right now we're seeing about a 0.5% spread. In other words, my borrowing costs, let's just say, are 5 and the policies earning 5.5. But we find that still is plenty of spread to accomplish what we're after. And if you're using it for a business or investment purpose, depending on your CPA, most CPAs are comfortable writing off the interest, which gives you even a little wider spread. And then the payback, typically, what we'll encourage clients to do is pay the interest each year so that they can get that immediate tax deduction. But really, there's no payback schedule. There's no, repayment or amortization or anything like that. And as long as the money's performing outside the policy, in other words, you've put it in a good place that's doing better than the interest you're paying, you really don't even need to pay it back because all we want to do is make sure we're making a spread on that policy loan each year.
Got it. So I take the proceeds, I invest in real estate or whatever. You mentioned you were building homes. Were you the active builder, or did you invest in a builder and buy and basically develop?
So originally I was lending to a builder, and then that builder came to me and said, "Hey, why don't you start a company and I'll kind of run it for you." That has since has evolved into one of my sons sold their business and he wanted to get involved in building. So now he runs that company. But yeah, it was all funded from capital coming from my policies originally. And and since then, like I say, we do a lot of different things. I will point out one thing that we kind of do, it's a little unique. We've got a strategic partner that helps us with equipment leasing. Now, the only reason why I point that out is it's because it's one of the few things you can get really immediate, massive tax deductions. So oftentimes what we'll do is we'll get the policy built, we'll take a loan, we'll get some equipment, we'll get a massive tax deduction, we'll take all the money that we've saved in taxes and the distribution from the equipment leasing, put it right back into the policy, and now we can work it into, a longer term investments such as, commercial real estate, or we like multifamily, things like that.
Got it. So the circle is, again, you buy the policy, you borrow from the policy, you put it into the the investment. The investment then creates a return, and you funnel that back into the policy to pay the interest and pay back the loan if that's what if that's something you want to do. Otherwise, you basically, I mean, I guess what I'm trying to figure out here is the the proceeds from that investment, whether it be real estate or a company or whatever, is that then is it taxed as just ordinary income then, or how?
Yeah. So if I've gone, let's just say I've used it for an ordinary investment, then obviously the ordinary investment is going to have a taxable event, but I'm going to be able to deduct part of that interest by or excuse me, part of that return by the interest I've paid. So as an example,
Gotcha.
let's say I'm earning 12%, but I'm paying 5 for the use of money. So now I'm only going to pay tax on 7 instead of 12. But the
Okay.
beauty of life insurance is even when you have a loan, your policy still compounds and grows in and of itself. So I may be paying 5% interest, getting a deduction, but then my policy is still growing internally at 5.5 or whatever that number is. And so I still get my 12%, but instead of paying taxes on 12, I'm only paying taxes on 7. So it's a much more efficient way to fund your investments. I hope that makes sense.
Yeah, no, it takes just a minute to kind of draw the picture, I guess, and kind of follow along. But it's as far as the I guess the flow of the money that so the policy all by itself has a built-in return. And is that a guaranteed rate of return on the whole life?
There usually is a minimal guaranteed return, but the excess, if you will. So, like most companies have about a 3 or 4% guaranteed return, and then they pay the dividend or the earnings on top of that. So, the nice part about it, like some of the companies we worked with, they're 170 years old, they've never missed paying a dividend. So you can, even though you can't say it's guaranteed, it's very reliable um, to get that 5.5, 6%, whatever they declare for the year.
So if you say you do fund a policy with like 150,000 and you've got a loan out for, say 100, and but the policy continues to earn interest on the 150, right?
Exactly. That is the unique thing about doing this strategy is whether you have a loan or not, you're still getting the internal buildup.
Got it. And so your obligation then would be just to make sure you pay back the interest on the 100 that you borrowed. And but meanwhile, like you said, you even invested the 100 in some other vehicle that presumably you're set to achieve a better interest rate.
Exactly. And one of the simplest things that we do is oftentimes people don't have the opportunity immediately to start using their capital. So we've actually created well, I should say one of my partners has created a fund that buys other people's policies. And that fund gives us about a 1.5, sometimes a 2% spread. So at the very least, we can take loans from our policy and go buy other people's policies and make even more money.
Wow. All sorts of creative ways to do that. And but again, so and just to kind of complete the circle on the insurance. So if if at the end of the day, you expire and there's a cash value policy, but there's a loan against it, the the proceeds, the benefit is the net. Is that not true? Is it the between? I mean, if you've got an outstanding balance on a loan that you took, and so if it's grown to say 180,000, but you still have that $100,000 loan out there, um, am I thinking that through right? Or
Yeah, yeah, no, exactly. Again is another huge advantage of using life insurance is it's going to build a legacy and a generational wealth, no matter what. So if I have typically a policy that you put $150,000 in, let's just say the guy's 45 years old, he's probably going to have 8 or 900,000, maybe even $1 million in death benefit. So let's say he has $1 million and he dies and he's got $100,000 loan. The loan's forgiven and $900,000 is handed to the family. So it's a way to use your capital, have the death benefit pay off any loans, and then still leave a legacy for the family or business partners or whoever.
yeah, I guess the piece I was missing there in my little math example was forgetting that the face value of the policy is probably substantially more than the cash value. So that's no, that's interesting. So tell me kind of the ideal um, candidate for something like this? Probably age and kind of what their situation might look like.
Well, I think the ideal is anybody who's looking to build up their wealth, because whether they have opportunities in real estate or anything else, just leveraging life insurance within itself is a very productive and predictable way to build your wealth, and do it, tax advantaged. For others who are looking to invest and have capital to invest, if they'll just get it stuck, if they'll just get it put into put as much money as they can into these policies before they make their investment, and then use the policy as the funding mechanism, then that investment will just get better. And again, maybe I can use myself as the best example. When I went to buy this student housing, what I did is I've got about 9 policies now. So I just shoved as much money in those as I possibly could. I paid back some loans and everything I could to get that money in there first. Then I took the loan, have bought the student housing, and now I'll let the cash flow from that student housing put the money back into the policy, and then it's ready to go again, rinse and repeat. But my student housing rate of return went up about 7.5% because I used the policy. And then, of course, I got the generational wealth. So if something happens to me, not only is the policy paid off, student housing is paid off, and there's still a huge tax-free death benefit that goes, to my heirs. So all in all, it'll just make every situation better.
Yeah. So you mentioned multiple policies. Do you find that that's typically what people will do once they find the benefit of, how well it works with one, they'll, you know, add another policy kind of thing to try and increase their ability?
Yeah. So what happens is oftentimes people will start a policy, and then their financial life will improve. Maybe they get a better job or whatever. And now they have the capacity to save even more. When you build a policy, let's say I build a policy for 50,000 a year, I'm maximizing that policy up to what the IRS will let me do. In other words, um, if you put in too much money too fast, you lose the tax benefits. So we build the policy based on what somebody can put in premium. So if they could put in $50,000 today, then that's how we're going to build that policy to max out every year at 50,000. But if at a year from now, who knows, maybe they get an inheritance, sell another asset, and now they've got some more capital. Because we can't put it into that policy, we'll just start another one. Well, since I started funding these policies way back in the 90s, I, couldn't fund everything that I can today. So over the years, I've just had to add more policies, because I would love to put every penny I earn through a policy first. Unfortunately, that's kind of not possible, but I definitely want to put in as much as I can. So anytime an insurance company will let me have another policy, I build another one.
Got it. So what is the hurdle that you face when you're talking with prospects about this? What is it that they typically stumble on, don't get, or is it everybody gets it and it's like there's no issues with, let's just go, God, sell me another one.
Well, I think the first thing is people just think life insurance is you got to die to use it, and they don't understand the living benefits. I mean, the cash flow that can come off of these for retirement income is so much greater than a 401k, as an example. So I think it's just the misunderstanding, and the fact that, Wall Street kind of has the market, so to speak, and when you walk into your job, and the first thing they want you to do is invest in a 401k, which is mutual funds in the stock market. And it's just, it's kind of a dominated world. But once people understand what you can do, and they try to figure out a way to do it with as much money as they possibly can. But yeah, it's just misunderstanding and lack of knowledge that you can do some of these things. But it's pretty exciting. I mean, we have huge business clients. This is great for businesses, by the way. One of the most effective retirement plans, if you will. that they can use and still keep all their cash and use it to reinvest within the company. So yeah, once they kind of catch the vision, see the designs, people dive in as much as they possibly can.
Yeah. I was going to ask you, it seems like recently I saw a statistic or something about what the average American had saved for retirement. And I was like, holy smokes. I mean, the number was just like, I was going like, well, you're not going to retire. I
Oh,
mean,
you're exactly right. In fact, I just did a video on this, oh, maybe 2 or 3 months ago. The average 60-year-old has $165,000. I
mm,
mean, you're done in a year and a half, 2 years.
yeah.
It's tough. So yeah, you got to figure out a way to save. And of course, we kind of go with that Kiyosaki rich dad, poor dad, and the richest man in Babylon philosophy, where you got to pay yourself first. You got to put away money for yourself first. Get those assets built up. There's no better place to store your capital than within a well-designed cash value life policy, and then start looking for opportunities. It might be your own business or real estate or whatever, but the fact is having that capital available and looking for alternative ways to build your wealth is much, much more productive than, putting $50 a month into an IRA.
So let me ask you, I know like in real estate, there's limitations with what you can do. I guess more like from an IRA, as far as lending, I guess you can't lend to your parents or your kids, but I guess you can lend to, anybody outside or like nephews and nieces and that kind of stuff, but you can't, and people unrelated. Are there any restrictions on what you can, as far as lending or I guess taking a loan, are there any restrictions or limitations on what you can do?
Zero limitations. In fact, they don't even ask you what you're doing with it. You can literally do whatever you like. And when we're using banks, they actually just give you a checkbook so you can do anything you want. There's no questions asked, no amortization schedule, no payback schedules. We can manage all that ourselves.
So are there any challenges then when like working with your CPA to do your taxes recognizing what what's an interest payment versus what's, you know, otherwise, or is it all follow form?
It's all pretty straightforward. I typically will just look on my account statement at the end of the year, see how much interest I paid, hand it to my CPA. He deducts it. Pretty simple.
Wow. No, sounds pretty good. Um, so with the people that you're working with, um, is there I mean, is real estate typically the investment that they make if when they borrow against their policy?
It's kind of all over the board. Oftentimes it's just situational and what they're comfortable with. We've got clients who are comfortable with Bitcoin mining. So they'll use their policy for that. E-commerce, a lot of Amazon store owners use their policies for funding product. Um, Real estate again is a big one. We like multifamily. We do put together syndications. We're working on 2 or 3 right now, and so some of our clients will get involved with those with us. Um, they might have their own deals that they can work. Um, so yeah, all just about anything is available. Like I mentioned earlier, just the equipment leasing, just so that you can wipe out your tax bill. We had a lot of success this year with some doctors and dentists and other professionals and business owners just eliminating their taxes. And some of them were, you know, $500 million in taxes that were eliminated, that now that money can be put into their system and just build more assets from there.
So I'm curious, do people seek you out, or are there like traditional professionals that are referring people to you? Because I just, as I'm thinking through this, it seems to me like a lot of the go along, get along kind of group, whether it be a stockbroker or even an accountant, may not necessarily be thinking necessarily outside the box like this.
Yeah, and that's kind of why I got out of that traditional financial planning. It was impossible to think outside the box. You had to stay within, their realm, so to speak. And I would look and I would see other things happening out there, and real estate as an example, and saying, look, I'm a traditional financial advisor here, and I can't even look at real estate because my broker dealer won't let me. So alternatives is what really excited me to become independent. But we do have quite a few CPA groups around the country that refer us. I've spoken Dallas the last, oh gosh, I think I've been to Dallas 3 times in the last 7 or 8 weeks, speaking with a trust attorney, because this works really well with all sorts of trusts. And yeah, and then there's just a lot of independent financial advisors out there who will utilize our process as well.
Got it. So when I was preparing for this interview here, I saw, did you write a book? Um, Something like Four Keys to Building Wealth? Is that?
Yeah, I've actually wrote 4 books. That's my fourth one. And that, yeah, it's called The 4 Keys to Building Wealth. And it just talks about the easiest way to build your wealth is kind of what we're talking about. And the 4 keys are time, compounding, leverage, and tax advantages. And when you combine all those things into safe, predictable assets, you almost accidentally grow your wealth. It makes it a lot easier.
Yeah. No, the first one there, the time thing, I think is the one that you know, recognizing having had some time, just how critical that is to it. I think everybody gets kind of you know, the shiny object, kind of the fast cash kind of thing, but the that time thing really kind of cures or makes it all work as kind of my experience. So makes
Exactly.
sense.
And you've I'm sure heard the comparisons of you take an 18-year-old who saves $2,000 a year, quits saving at age 26, really never has to save again and is a multimillionaire, but 65. Take somebody who doesn't even start saving till they're 40. They have to save for 25 years and save about $6,000 a month just to catch up. So time is huge. But I kind of use time as a different example too, and that is none of us know how much time we have. So we've got two things to compete against. One is just, life itself, and how are we going to make sure our families are protected in case our time is cut short. And then time, time value, meaning get your money working as quick as you can for as long as you can to build up as much assets and income as you can.
No, well said. Well said. Hey, Dan, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there are 3 strategies we typically consider. We first look to see if we can avoid the risk. If that's not an option, then we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, the Fed, um, political, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Dan Thompson, what is the biggest risk?
I think the biggest risk is to sit idle and do nothing, to be so paranoid of risk that you take no risk. And there are some very predictable ways to get your money working and invested and still keep the risk down. But it just kills me sometimes when I talk to somebody. Well, in fact, I just talked to a potential client just yesterday who's sitting with $1.7 million in a 4% CD. And just like, so that to me is more risky than putting the money out at quote unquote risk and having it grow for you. Because if you're not at least going to keep up with inflation, you're going backwards every single year.
Yeah, and that's definitely something in recent times that's more problematic. So, well said. Dan, where can the listeners go if they'd like to learn more or connect with you?
So I have a YouTube channel. That's probably where most people connect with me. It's called Wise Money Tools. And I think I've got over 600 videos out there. We even do that in Spanish. So we have Wise Money Tools Espanol for people who speak Spanish, and that's kind of fun. I got a really really super smart assistant who speaks Spanish, and she does great on those videos. So that's the best place to catch us. wisemoneytools.com is the website. You can always reach out to me just at dan@wisemoneytools.com, and happy to answer any questions you have.
All right. Well, Dan Thompson, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Awesome. Well, thank you. It's been great talking to you, and you have a hopefully everything's just going great in your world, and look forward to talking to you again as well.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.
You're listening to CRE PN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CRE PN Radio.